2024, a Vanguard study tracked 8 million retirement accounts. The median balance for Americans between 45 and 54 was $61,000. Not 600,000, 61,000. And if you've ever plugged your own number into one of those online retirement calculators, you know exactly what happens next. The bar turns red, the projected shortfall appears, and a quiet, persistent feeling sets in that no matter what you do, you're already too far behind to catch up. Here's what's strange about that feeling. It shows up in people who are saving, people who are invested, people who are doing most of what the advice columns tell them to do. So why does the math still feel broken? Because the calculator isn't measuring what you actually have. It's measuring the gap between where you are and an arbitrary finish line, and it's ignoring the most important variable in the entire equation. That variable is trajectory, and that's what this video is about. If you don't understand how compounding actually builds, where the growth comes from, when it arrives, and why your current balance is almost meaningless as a final number, you will keep making decisions based on a snapshot that was never designed to tell you the whole story. My name is Alex, and if you've ever felt financially responsible, but quietly unconvinced that it's actually working, stay with me, because the math looks very different once you understand how it actually moves. I'm going to show you exactly where your wealth is being built right now, and what a realistic trajectory to 7 figures actually looks like from where you're standing. Once you understand this, you won't just feel better about your balance. You'll know precisely what to adjust and what to leave completely alone. The place to start is with a concept called a bearing correction, and it changes everything about how you read your own financial position. There's a number most people have never heard of. It's not a stock ticker or an interest rate. It's called a bearing. And once you understand what it means, the way you read your own financial life changes completely. In navigation, a bearing is a directional heading. It doesn't tell you where you are. It tells you where you're going. A ship doesn't reach its destination because it started at the right port. It reaches its destination because it held the right angle across thousands of miles of open water. Position matters far less than direction, and direction, once set, compounds over distance in ways that are almost impossible to correct late in the journey. Here's why that matters for your retirement account. Most people treat $1 million, or whatever their target number is, like a finish line. Either you're on pace to cross it, or you're not. The online calculator confirms one or the other, and you either feel okay or you feel behind. That's the wrong frame entirely. $1 million is not a finish line. It's a bearing. It's a point on a trajectory. And the question that actually matters isn't whether you've accumulated enough yet. It's whether you're pointed in the right direction. The ship metaphor earns its place here because it captures something the calculator misses. Imagine a freighter leaving the port of Baltimore, loaded and on schedule, pointed toward Hamburg. On day 1, everything looks fine. The engines are running, the crew is competent, the weather is clear. But the navigator set the initial heading 2 degrees off. Not 10 degrees, not 45, 2. For the first few days at sea, nobody notices. The water looks identical in every direction. The instruments show normal. The ship feels like it's making progress. Because it is making progress, just not toward Hamburg. By the time land appears on the horizon, it's the wrong coastline. Not because something broke, not because the crew was negligent, because 2 degrees, held consistently across thousands of miles, become an entirely different destination. Now flip that around. What if you caught the error at mile 50 instead of mile 5,000? The correction is almost nothing. A slight turn of the wheel. A trivial adjustment that costs almost no time, no fuel, no drama. The same correction at mile 4,000 is a completely different problem. It costs weeks, resources, and in some cases, it simply can't be made in time. That is the whole game. Not the size of the correction, the timing of it. And here's the part worth sitting with. Most people who feel financially behind are not off by 45 degrees. They're off by 2. They're already invested. They're saving something. They have an account that's growing, even if slowly. The engine is running. The ship is moving. The issue isn't that they've failed. It's that a small number of variables in their current setup are pointing them slightly wrong, and small angles become large distances over time. This year, the number Americans say they need to retire comfortably is $1.46 million. When most people hear that and compare it to their current balance, the gap feels enormous, discouraging even. But that reaction is the navigational error. You're measuring the distance to the destination from where you're standing. without accounting for the fact that the ship is already moving and the trajectory is already doing most of the work. The bearing correction isn't a dramatic overhaul. It doesn't require a new career, a windfall, or a radical lifestyle change. It requires understanding exactly which variables are driving your trajectory and which ones you've been ignoring because the financial industry has very little incentive to make them obvious to you. There are 4 of them. 4 signs that tell you your bearing is already closer to correct than you think. And the first one is the most overlooked, because it works quietly, in the background, whether you're watching it or not. The engine is running without you. That's what it means to already be invested. And what that actually does to your number over time is almost nothing like what most people assume. Most people assume that building serious wealth requires a high income. That assumption is doing a lot of quiet damage. The bearing is now set. The direction is right. But understanding why the direction is right, why the machine actually works the way it does, requires looking at the most counterintuitive wealth story in modern American financial history. Ronald Redd was a gas station attendant and janitor at a J.C. Penney in Brattleboro, Vermont. He drove used cars. He used safety pins to hold his coat together. He cut his own firewood well into his 80s. When he died at age 92, his estate was revealed to be worth $8 million. Even his own family was tremendously surprised. His stepson told the local paper he had no idea. His neighbors had no idea. The only clue anyone ever noticed was that he read the Wall Street Journal every single day. No inheritance, no high salary, no inside information. He saved what little he could, invested it in blue-chip stocks, and then waited for decades, as small amounts compounded into more than $8 million. That's the whole story. And it's worth sitting with, because it completely dismantles the idea that income is the engine of wealth. It isn't. Time is the engine. Income is just the fuel. And you need far less fuel than most people think, provided you start early enough and leave it alone long enough. Here's what that looks like in concrete numbers. Take a dental hygienist named Meg, 36 years old, with $55,000 already sitting in her retirement account. She's not maxing out her contributions. She adds $500 a month consistently and never touches it. At a historically reasonable 7% annual return, that account reaches $1.7 million by the time she's 65. She personally contributed roughly $107,000 of that over 29 years. The other $1.6 million came from compounding, from time. She didn't need a promotion. She didn't need a windfall. She needed to have started and to keep going. But here's where most people's understanding of compounding stops short, and it's an important gap, because the incomplete version actually leads to bad decisions. There are 3 levels of understanding compounding, and most people are stuck at level 1. Level 1 is simply knowing it exists. Compound interest works. Growth builds on growth. You've heard this, fine. Level 2 is understanding when the growth actually arrives. It is not steady. It is not linear. It is dramatically backloaded. In a standard 30-year investment window, roughly 45% of your total wealth accumulates in the final 8 years. Not the first 8, the last 8. For 22 years, the curve looks almost flat, modest, unremarkable, easy to dismiss. Then it turns sharply upward, like a wave cresting just before it breaks. The problem is that most people abandon the investment during those flat years, precisely when they most need to stay. Level 3, the one that actually changes behavior, is internalizing that your current balance is not your number. It is a snapshot of a process that is running right now, in the background, whether you're watching it or not. The figure on your screen today is the ship's position at mile 400. It tells you almost nothing about where you land at mile 5,000. Ronald Redd understood this without ever using the language of compounding theory. He just bought stocks, refused to sell them, and kept working. Friends recall that he likely saved nearly 80% of his income starting in his mid-20s. He held at least 95 stocks for decades. He didn't optimize. He didn't trade. He just held and held and held until time did what time does when you refuse to interrupt it. The engine was running. He just didn't turn it off. And here is what Ronald Read never once said. But everything he did was built around the savings rate, not the salary, the percentage he actually kept. That single variable, how much of what comes in stays invested, is the lever that determines the final destination more than almost anything else, which is exactly what the next sign is about. The financial industry spends almost no time talking about the variable that matters most, and that silence is not an accident. Ronald Read never used the phrase savings rate. He never read a personal finance book, never attended a seminar, never opened a brokerage app on a phone he didn't have. But every financial decision he made for 60 years was built around one silent principle: keep more than you spend and invest the difference. He just never gave it a name. That principle has a name, and the data behind it is more decisive than almost anything else in personal finance. The personal savings rate in the United States currently sits at around 3.6%. That is the share of disposable income the average American household sets aside after taxes and spending. Not invested and growing, just not spent. Roughly 3.5 cents out of every dollar earned. Now compare that to what research consistently identifies as the threshold that predicts seven-figure wealth over a working lifetime. 15% of gross income directed into invested assets. That's your 401k, which is your employer retirement account, a Roth, or a regular brokerage account. Fidelity, which tracks more than 50 million retirement accounts, recommends a 15% savings rate and found that total average 401k savings rates, including employer contributions, are running just over 14% among active participants, which sounds close. But active participants represent a fraction of the workforce. The broader national average, including everyone who isn't contributing at all, tells a very different story. If you are currently saving 15% of your gross income into invested assets, you are not slightly above average. You are saving more than 3 times the national rate. That is a structural advantage, not a marginal one. Now here's where it gets interesting. The difference between a 10% and a 20% savings rate is not simply a 2 times multiplier on the final number. The math is more surprising than that. Take 2 project managers, same employer, same salary of $91,000 a year, same age, same market returns. Call them Nina and Greg. The only difference between them is what each does with what's left after the bills are paid. Nina saves 10%. Consistent, disciplined, no major errors. Over 30 years at a 7% annual return, her portfolio reaches $1.4 million. That is a genuinely strong outcome. She did most things right. Greg saves 20%. He made one decision early in his career. Every time he got a raise, he held his lifestyle roughly where it was and redirected the difference into his investment account. His savings rate climbed gradually from 10% to 20% over about 6 years. Same market, same employer, same 30-year window. His portfolio reaches $2.8 million. The gap between them is $1.4 million. Not from better stock picks, not from a higher salary. From one behavioral decision made once, compounding silently for 3 decades. That pattern has a name. It's called hedonic lifestyle creep. The quiet, almost automatic tendency to spend more as you earn more. A better car after the promotion, a bigger apartment after the bonus, a few extra subscriptions that seem trivial individually, but add up to several $100s a month collectively. None of it feels reckless in the moment. Each upgrade feels earned. But every dollar absorbed by a higher lifestyle is a dollar removed from the compounding engine. And over 30 years, those dollars multiply into something you can actually feel. The financial services industry has very little incentive to center this conversation. A higher savings rate means less money flowing through managed products, fewer fees, and fewer reasons to call a broker. The industry's entire vocabulary is oriented around returns. Which fund, which allocation, which strategy. Returns matter, but savings rate matters more. And unlike market returns, it is the one variable you control completely, starting today, without anyone's permission. The National Study of Millionaires found that 70% of millionaires saved more than 10% of their income throughout their working years. Not 60%, not 100, 70. And if someone hitting all 4 signs in this video looks like anything, they look like the person who made that decision early and let time handle the rest. But pulling the savings lever is only half of the equation. The other half is protecting what you've built when the market inevitably makes it feel like a mistake. That's what researchers call behavioral alpha, and the gap it creates between investors who stay and investors who don't is far larger and far more permanent than most people realize. The most expensive thing most investors ever do costs nothing at the time. No fee, no transaction, no visible consequence. Just a decision made under pressure, in the wrong direction, at precisely the wrong moment. Pulling the savings lever changes your trajectory. But the lever only works if the machine keeps running. And the single most reliable way to break the machine, the one that has cost American investors more money than any market crash in history, is not a bad investment. It's a perfectly human response to fear. This is what behavioral alpha actually measures. Not skill, not intelligence, not research. Just the return advantage that comes from doing nothing when everything in your body is telling you to do something. DALBAR, the quantitative analysis of investor behavior, which is the longest-running study of its kind in the United States, has been tracking this gap for over 30 years. Over the 20-year period ending December 2024, the average U.S. equity investor returned 9.24% per year, compared to the S&P 500's 10.35%, 1.1% annually. That sounds like a rounding error. Run the math on a $140,000 portfolio over 30 years, and it isn't. The difference between those two return rates on that balance compounds to roughly $280,000. Gone. Not from a bad fund, not from high fees, not from a market collapse. From moving money at the wrong time repeatedly across decades. And the more recent data is sharper. In 2024, the S&P 500 returned 25%. The average equity investor earned 16.5%. Withdrawals from equity funds happened in every single quarter of that year, with the largest outflows occurring in the third quarter, right before a major rally. People sold at precisely the moment they needed to stay, not because they were careless, because the headlines were alarming, the losses felt permanent, and the instinct to protect what remained felt like the responsible thing to do. DALBAR's guess-right ratio, the frequency with which investors correctly time their moves in or out of the market, fell to just 25% in 2024, 1 in 4. That means 3 out of every 4 active timing decisions made by retail investors that year were wrong. And yet the behavior continues, year after year, because it doesn't feel like guessing. It feels like reading the situation clearly. That's the trap. The market doesn't punish ignorance. It punishes confidence at the wrong moment. Consider a hospital administrator named Claire. She had been invested since her early 30s. Broad index funds, automatic contributions, nothing complex. When her portfolio dropped sharply over a rough 12-month stretch, she didn't panic immediately, but she started checking daily, then weekly. Then she started shifting money into cash, telling herself she'd move back in once things stabilized. By the time she re-entered, she had missed the first 9 weeks of the recovery. On her $140,000 account, that single decision cost her roughly $26,000 in gains she was simply absent for. She didn't lose money to a bad investment. She lost it to a rational, understandable, completely human response to an uncomfortable situation. The fix is not willpower. Willpower is a resource that runs out, and markets are very good at depleting it. The fix is structural friction, building a system that slows you down before you can act on panic. A 48-hour mandatory waiting period before making any portfolio change is one approach. Some people go further. They remove the brokerage app entirely during periods of volatility, the same way you might take a different route home when you're trying to break a habit. The goal is simple: create distance between the emotional impulse and the execution. Your rested, logical brain almost always reaches a different conclusion than the one you had at midnight watching the market ticker. You just need to give it time to show up. Claire eventually reran her numbers properly and realized the timing error, while painful, hadn't broken the trajectory. The compounding she'd built over a decade was still working. The bearing was still correct. One bad move hadn't sunk the ship. Which raises the next question worth asking. If behavior costs this much, and the pattern is this predictable, why do most investors still pay someone to manage their portfolio actively? Follow that incentive, and the answer to indexing wins becomes obvious. And more expensive than most people have ever calculated. You are paying someone to underperform the market, and the fee is not the expensive part. Behavioral alpha protects what you've built. But there's a second silent drain running alongside it, one that doesn't require a single emotional decision, doesn't spike during market corrections, and doesn't announce itself anywhere on your account statement. It just runs, every year, compounding in reverse. It's called the active management fee, and most people who are paying it have never actually run the math on what it's costing them. Here's the context that makes this worth understanding. Over the 20 years from 2005 to 2024, 94.1% of all domestic actively managed funds underperformed the S&P 1,500 composite index. Not half, not two-thirds, 94%. Over a 15-year horizon, there was not a single fund category in which a majority of active managers managed to outperform. Not one. The data on this has been consistent for decades. The conclusion it points to is not complicated. For a retail investor, simply refusing to play the active trading game is one of the most statistically defensible financial decisions available. And yet active management persists because it has a very effective sales pitch. It sounds like competence. It feels like protection. It comes with a manager's name, a track record, and a professional opinion. What it rarely comes with is a clear statement of what it actually costs over time. Currently, the industry average expense ratio for mutual funds and ETFs sits at 0.44%. Vanguard's average, by contrast, is 0.07%. The gap between a typical actively managed fund, which often runs at around 1%, and a broad index fund at around 0.07, looks trivial on paper. 1% versus almost nothing. Who cares? Run the math, and you will care. Take $350,000 invested over 25 years at a 7% gross annual return. With a 1% annual management fee, your net return drops to 6%. That $350,000 grows to roughly $1.5 million. Remove the fee entirely, index the position, and the same $350,000 at 7% over 25 years reaches approximately $1.9 million. The fee costs you $400,000, not in flat charges. In compounding that was systematically redirected away from your account, year after year, in a percentage so small it never triggered a second thought. That's before accounting for the tax drag of high portfolio turnover, the hidden cost of active managers buying and selling frequently inside a taxable account, generating capital gains events that erode your after-tax return further. Index funds, by design, trade rarely. The compounding efficiency is structural, not incidental. There's a type of investor the financial industry quietly loves. Call him the anxious optimizer. He has multiple brokerage accounts, checks his portfolio before his morning coffee, reads the research notes, and subscribes to the newsletter. He's always making adjustments, rotating sectors, trimming positions, chasing the fund that outperformed last quarter. He's working hard. He's paying attention. And statistically, he's almost certain to underperform someone who set up a low-cost index fund 15 years ago and hasn't logged in since. Effort, in investing, is frequently its own punishment. Someone hitting all four signs in this video, already invested, saving at 15%, holding through volatility, indexed at low cost, looks like a civil engineer named Diane. She's 44. She's not wealthy by any visible measure, but her trajectory puts her past $2 million before she turns 65. She didn't find a secret. She just stopped doing the things that cost money without producing returns. Which brings us to Marcus. He's a pharmacist in his mid-40s who spent years convinced he was behind. A standard online retirement calculator told him he couldn't retire until 73. That number landed like a sentence. So he finally sat down and plugged his actual numbers in. Real balance, real savings rate, employer match included, historical return assumptions rather than pessimistic defaults. His real retirement age came back at 61, not 73. 61. By simply running the correct math, he handed himself 12 years of his life. 12 years. Not from a raise, not from a career change, from replacing a broken calculator with an accurate one. That's what recalibrating your true number actually means. And it's where all four of these signs point. Here is what this video actually was. Not a pep talk. Not a reframe designed to make you feel better about doing nothing. It was a mechanism, 4 specific variables that determine where a financial trajectory ends up, regardless of how the account balance looks on any given Tuesday. The central insight is this: your current number is not your final number. It is a snapshot of a process that is already running. The machine does not care whether you're watching it. A few things are worth carrying forward. Savings rate beats income almost every time, across almost every study. Behavior is a return. Staying invested through a downturn is not passive. It is the active decision that most investors fail to make. Fees compound in reverse. A fraction of a percent, sustained over decades, is not a rounding error. It is a destination, and time is the one input you cannot buy back once it's spent. Here's what to notice going forward. When you feel the urge to move money because something feels uncertain, pause. That feeling is precisely when the bearing correction earns its keep. The ship doesn't need a new captain. It needs the wheel held steady, which raises a question worth sitting with before the next video. If these 4 variables explain how wealth accumulates, what explains why most people never find out they were already close?